Currently, the Tax and Jobs Act summary of 2017 is the current tax law that we have in place, passed last year, effective with your tax returns in 2018. A lot of changes, but from what I saw during the 2019 tax season, doing 2018 returns, not a lot of difference in income tax payable on the farms that we work with. So the focus of the seminar series here is transitioning businesses from one generation to the next, or one generation to another. So my part is tax concerns of transferring a business, and hopefully will jive with the other seminar series that have been recorded or had been held prior. So basically, when we start or have someone come to us and talk about transferring the farm from one generation to the next, there's basically two ways and questions that you need to ask yourselves are, can you work together, number one, or do we have to just start over, cut the cord, and the next generation moves on by themselves? So that's the first real big issue, which I assume was probably covered in a prior seminar, but really setting up the business, the next generation in their own business or working together for a while is one of the main decisions to be made. And then, of course, transferring the business not usually requires profitability. I'm guessing Anna or someone prior talked about that. Some of the farm credit consultants came up with this slide, balance sheet considerations when transferring the business, maintaining an adequate equity position so that if you had to go to the bank for some unforeseen costs, you're going to be able to continue the plan of retirement, but still maintain the business and keep it profitable. Higher equity businesses obviously have the ability to offer a better retirement package, but we try to work with whatever we have, and the main goal is to keep the farm going and keeping everybody happy. But you have to really do a lot of planning ahead and budgeting to make sure that you can maintain the cash flow for the exiting generation. Again, another slide from the consultant page of Farm Credit. They figure that an additional $48,000 of net farm income could require up to $160,000 of gross income using a return on assets of 3%. So another, profitability, earnings drives everything. So you really need to take a hard look at the business and can you afford, replacing the elder generation. You're going to have to replace the labor, and that's got a cost to it as well. So tax concerns of a business transfer. Number one point I have up on the slide here is that don't make taxes the major obstacle. Ideally, we can work around that if everybody's in agreement and everybody is on the same page of keeping the farm enterprise going. There's usually enough wiggle room to not have the taxes be the major obstacle. It's not something you can ignore, obviously, but it shouldn't be the major obstacle to transferring. I don't know, I probably have 1% of the farms I deal with that like to pay taxes or are willing to pay taxes. I guess not like. So most farmers have created a tax-deferred liability on their balance sheet, even though it may not show up. And what I mean by that is, I think any statistics you see nowadays, the average age of farmers is maybe 55 to 60 years old. So they probably bought the farm for maybe $300, $400, $500 an acre, and now might be worth $2,000, $3,000 an acre. So so they've got a built-in gain on the land of maybe $2,500 an acre. And then depending on how aggressive they've been with not paying taxes, if you will. And what I mean by that is if every year when you purchase equipment for cows or buildings, if you've made a concerted effort not to pay tax, you've used up that depreciation, and there isn't enough paper offset on your tax return to offset any possible gains when you do finally have to transfer or figure out how to transfer the assets. So it's not going to be an easy job, but there are ways around it. Most importantly, I think plan ahead. I mean, it's not your job to understand the current tax structure. It's my job, or somebody like myself. Get advice, do some planning. I assume that the prior sessions that were in this series have built on those points of lots of planning, how to attract the next generation, and how to position your business to be able to do that. So I bet 75% of the people I talk to, well, am I going to have to pay capital gains on that when we talk about selling the farm or selling assets? And to me, there's a big disconnect on that fact. I mean, capital gains are the prime item that you want to have. And so on this slide, if you look at the two columns where we still have a marginal tax bracket effect for personal income taxes, the side, basically all these brackets, the ordinary brackets, went down 3% with the new tax law, but they did not change the capital gain benefit. So the first $78,000, give or take, on a married filing joint federal return, capital gains are taxed at zero. So that's a pretty significant number, because that's taxable income, so it's after deductions. So that's a big number to plan for. Pretty nice number if we can structure the assets base to mostly capital items. Probably on the federal side, work it so that there isn't going to be a lot of federal tax liability. Unfortunately, New York State doesn't give you the benefit of capital gains tax, and oftentimes on a transfer, I've seen New York State tax liability higher than federal. Oops, wrong way. Again, New York State tax, same type of marginal tax brackets. I usually use about a 6 or a 7% figure for New York State tax when trying to figure out a possible tax liability on a sale. You shouldn't ignore it. It can't be ignored. Some people have investment tax credit carryover or some sort of New York State tax credits that carry over. So you want to take a look at your current carryovers on your tax return and to figure out whether you have enough or not to get rid of that New York State tax liability. So tax implications of transferring assets. Again, reiterating on the 2018 capital gains rate, up to $78,000 it's taxed at zero, and then the next $400,000 is only taxed at 15%. So capital gains is a huge benefit. The only caveat to the capital gains is if you've had the real estate have sort of phased out or are renting it, or not even renting it, it's just been vacant. If it's not been involved in a business for a couple, 3 years, you could get hit with the net investment income tax, which is another 2.9% on top of the 15% capital gains. So the taxable gain is the sale price minus your cost basis. So again, going back to you buy a $30,000 tractor, we depreciate it out either in the first year or over 7 years. So your tax basis is zero. You sell it for $10,000. Subsequently, you've got a $10,000 gain. Same deal with the land. Equipment sales are ordinary income, which I would refer to as the bad type of income. You want to minimize any type of ordinary income because you cannot installment sales. So in other words, you can't say, well, we're going to sell the equipment over 3 years and get $100,000 a year for 3 years. That's fine for a plan, but the income tax ramification of that is that all $300,000 is taxable in the first year because you're not allowed to installment sale ordinary income items like that you've taken the paper deduction for. So that's a big trap if you get into that situation. Property that passes through an estate receives a step up to basis to current fair market value. So currently the federal estate tax limit is 11,750,000 ish per person. So they've, on the federal side of things, we've pretty much eliminated any estate tax payable. New York State is still at about 5.7 million, so there could be a little bit of estate tax payable, and New York State tax is about 16%. So that can factor into what gets transferred. A lot of, if you're collecting real estate, if you will, a lot of the people that I deal with, the one guy says, well, they're not making any more of it, so he's looking to buy whatever he can. So from that standpoint, if you're looking at a long-range plan, you might want to consider putting the real estate into a trust so that the future appreciation stays there, and the next generation, it's there for the use of any farm, either whether it's a relative or, we have to plan ahead now for non-farm relatives. So whether the trust agreement's written so that as long as you're in the operating entity, you have the ability to use the real estate that's associated with that entity. So we're seeing that type of long-term planning for the real estate, because that's where a lot of the growth, and value of real estate is or growth in value, and there's no reason for the next generation to have to. It's hard enough to buy the operating assets, let alone get involved with the real estate purchase too. If it does go through an estate, if it's not a large tract of land, or there's some planning ideas, depending on how aggressive the younger generation is, to put the land in a different type of trust, an income-only trust, so that it it's still exempt from Medicaid after 5 years, but would receive a step up at death. So different planning opportunities depending on where your direction is. Part of another option, if you're fortunate enough to be low debt or very high earnings, profitability, gifting. Gifting with the IRS, everything's give and take. So if I get 100 shares of IBM and somebody paid $100 for it, that's my basis. I didn't pay anything for it, so whatever the person that gave it to me had bought it for is what I receive as a basis in it. And then if I subsequently sell it, I probably have a gain. That's if I bought it, then somebody's paying tax and I get the benefit of what I bought it for, as opposed to carryover basis on gifts. So 4 ways to transfer. Selling, we sort of talked about that. Sometimes the older generation becomes the banker. Growing into a new business, we've done a lot of profit interests, limited liability companies, taxes, partnerships. Grows in the younger generation, again, not probably 0 to 1% of anybody that coming in to try to buy some kind of farm operation cannot come up with the capital to do that. So can the older generation afford to sell at 50 cents on a dollar, or do we try to gradually shift some equity to the younger generation over a set number of years or a planned number of years, and then try to finance it or have the tax implications be low enough where the future generation can buy in and buy out the older generation? Talked about the gift deal. Don't see a lot of that going on. There's an annual exclusion. So the estate tax that I talked about prior, it's called a unified credit. You can either give away or die with that $11,700,000 figure. There's an annual exclusion amount of $15,000 right now, which doesn't eat into that lifetime exclusion. So you can give away $15,000 a year to as many people as you want, and there's no gift or estate tax payable, and it doesn't eat into your lifetime credit. So we've got some transitions that use a combination of gifting and profits interest. And we sort of talked about the inheriting, the step up to fair market value benefits, the generation inheriting it, obviously. But there's some issues with that. I mean, the aggressive next generation may not want to wait for ever and ever and ever, and might have some siblings. I mean, if everything gets done properly with all the legal ramifications, they might have some safety nets, but that's a long way to wait for some aggressive people that don't want to wait that long. So possible succession operations continue to farm as a full-time operation. The older generation is active partner, or they phase out of management altogether, or just phase out of management. They go from being president of the company to CEO or gopher, if you will, and just kind of, stay on the farm. They don't want to really leave, but they don't want the responsibility of the day-to-day operations. A couple ideas that we use to try to spread out tax liability, if you will. Ideally, beginning and end of the year is one of the best tax planning moves. I put an example here on the screen. If you've got a gain of $400,000, that's not sale price or basis. I'm just using a simple example. But a gain of $400,000 using the marginal tax brackets, that puts you in a 32% marginal tax bracket. So if you receive that whole entire $400,000, it's all ordinary income in 1 year. Your federal tax is $90,000 and some change payable. If you, on the other hand, took half of that money at the end of one tax year and the other half at the beginning of the next tax year, it's $36,000 and change each year, for a savings of about $18,000, and that's just federal taxes. So state would be probably not quite as big savings, but I'm sure the state would be a savings too, just by the pure math of the marginal tax brackets. Ideally, you're planning ahead and having conversations with the next generation to be able to manage sale price of asset types, if you will. As I mentioned, equipment and single purpose buildings are not good for the seller. Unfortunately for the buyer, it's a give and take, because the buyer can depreciate those items, and if there's a lower value on those, then they don't have as much to depreciate going forward, and you might set them up with not the best tax situation going forward. On the other hand, land and cows are capital assets, 1231 assets, so they get the capital gains treatment that I was referring to. The first $78,000 on a married filing joint return is taxed at zero. So if there's some flexibility there, you can bump up the price of the cows and take down the price of the machinery a little bit, enough to manage some tax liability with there. Your personal residence, if that's involved on the sale, that's still the biggest tax break there is. The current tax law, there's been several. There was a lifetime exclusion a while ago, $125,000. Now, the personal residence on a married filing joint return is exempt from gain up to $500,000. I was involved with a summary from Cornell a while ago, and they were amazed at the prices of the value of farmhouses that were sold with farms. They were all $200,000-$300,000 houses that got sold with all these farms in the summary. So it's not uncommon, and I've seen it work actually to the advantage of the purchaser, because even though they pay for whatever the number is, $250,000 for the house, they get to depreciate that as a tenant house theoretically, and or if they sell it subsequently at a loss, that offsets some gains on their farm going forward. So it can be a win-win, even putting a large value on the residence. It's definitely a win for the seller. There's still farm income averaging for returns, personal income returns. Sale of farm assets, except for land, qualifies for farm income averaging. You're able to take the 3 years, the past 3 years, take a portion of this year's current income, divide by 3, recalculate your tax in the prior 3 years, and ideally come up with a lower income tax payable this year than having it all taxed at whatever marginal rate you're at this year. I've seen that savings from 20,000 to I had somebody that saved 142,000 in income tax payable last year. So it's a huge tool. If all the stars align, it can be a big savings. For multiple entities from a tax structure. So there was more advantage prior to this year. So with this year's tax laws, Section 179 went up to $1 million, and basically anything you buy, you can take 100% write-off on. So prior to that, I liked more than one entity because by entity, there's that $1 million is a maximum, but on your personal return, it's the same maximum. So if you have 2 or 3 partners in your LLC and you claim the maximum 179, you only get a third of that on your personal. So if you're in 2 or 3 entities, that can take extra if you need it, and it all winds up, and you can max out your individual return. That's probably the only pure tax reason to do it. The trust, I mean, obviously you're keeping the appreciation in the trust outside everybody's estate. So the question is on partnership taxation, which is highly complicated and makes no sense at all if you're trying to understand it. But basically, the IRS allows you to withdraw money from a partnership tax-free as long as you have a tax basis in your capital account. And whatever debt you're signed on for is an addition to your bank account. So on a lot of the profits interests LLCs that are set up, the younger generation has 0 tax basis capital account bringing in. They might have owned 50 cows, but raised cows have no tax basis, or they've depreciated them some other way. So they're bringing in a beginning balance of 0. If they don't have enough profits share, which I recommend a minimum of 20% for the guys that are starting, just to get them enough money to offset possible losses and or draws. So the 20%, if the farm made $100,000, they get $20,000 credited to their account. If they pay tax on what they took out to live on, then their $20,000 goes into their capital account, and they just went up, $20,000 in their capital. If it's $1 million business, it's 2% or 0.2%, whatever the number is, but at least you're not going backwards. The negative capital account basically comes from either too many distributions and not paying tax on them, or being aggressive with your depreciation and not paying tax, period, as an entity. The problem with that is when you have, at the time when you go to transfer, the only way to get rid of a negative capital account, the only good way is to die. When you pass away with a negative capital account, it gets stepped up to fair market value and goes away. Otherwise, there's tax implications of negative capital account. So basically, it's an analogy to the death tax. The IRS is willing to wait around, and you can accumulate all these assets that you want, And when you pass away, they're willing to just say, hey, yeah, we'll let you collect all those assets, and then we want 50% of it when you die. Sort of the same thing with a capital account in the partnership interest. You're allowed to take out money as long as you have enough debt basis and or profits added until you go negative. Well, you can even go negative if you're signed on for the debt. But once you go over that debt limit, then it's taxable income. Then you're starting to pay it back, and or if you liquidate, you actually have to pay. So you're paying back. If you're negative 100, your first 100 is phantom income, if you will, because you're paying tax on that 100 grand that your $100 or whatever it is that you took out and didn't pay tax on it. IRS again is willing to wait around and settle up at the end, and it's going to be a big number that you probably don't want to wrestle with. So a guaranteed payment shows it's a deduction to the LLC. Then you split the difference after guaranteed payments, and then if it's also, I'm sort of leaning more towards that way on entities, only because everyone has the idea, if you're in a 50-50 partnership, whether I take 20,000 and my partner takes 50, we're going to wind up 50-50 at the end, and that's not really what happens on the tax return. So if you pay tax on what you take, and the disparity in your draw is taken out as a guaranteed payment, then your capital accounts and your distributions will be equal at the end, if that's the deal. So